Everybody, welcome to today's fundamentals. Hello, Peter.
Hello.
What's new in the markets?
Well, we had an easygoing Monday, low volatility practically across the board in the FX market. I would note that the US dollar seems to remain fundamentally driven, by the Fed's intentions. And there is also the possibility that the US economy may be slipping into a recession, and even if so, in a shallow one. And the third issue, which started to emerge once again, is practically the possibility of the US government defaulting, which, okay, it's a major issue, but for the time being, chances for such a scenario are remote. So it's something to keep an eye out, but I wouldn't worry much right now. Other than that, I would note that we had also the release of RBA's from Australia, RBA's last meeting minutes. I would say that overall the document was quite hawkish. It was characteristic that RBA policymakers noted that in Australia inflationary pressures are too high. And also they mentioned that there are still more rate hikes needed to actually be able to curb inflationary pressures. So practically, the bank verified that it's expected to more or less continue tightening its monetary policy, and that could be providing some support to the Aussie on a monetary level.
And how about US stock markets?
US stock markets also send out mixed signals for the start of the week. I would say that more or less it was a continuance since Wednesday, Thursday last week. They remain in a sideways motion mostly. Earnings releases are still influencing the market. I would be highlighting today, we have two main retailers. That would be Walmart and Home Depot in the US. And I would also be noting Coinbase. And it's interesting in the sense that especially the retailers are going to be showing us also the health of the consuming side of the US economy. While Coinbase has been through a number of troubles, especially with FTX, and there are a number of inquiries about the company. So once again, that would be interesting as well.
And what's on the calendar for today?
Well, we have a rather heavy calendar. I would start with the European session today, which we had the preliminary PMI figures from France, Germany, and the Eurozone. There was an interesting element here. We had the services sector in France increasing economic activity substantially. We had, though, the German manufacturing sector, which showed a contraction of economic activity even wider than January. Overall, though, the Eurozone, and it was characteristic that the composite index rose above market expectations. So overall, the situation seems to be pretty well. There's one main worry, though, and that's specifically on Germany's manufacturing sector, which is key. The manufacturing sector in Germany is the spearhead for Eurozone's economy. Other than that, we had also UK services PMI figure, the preliminary one for February. Right about now, we should be getting from Germany the CEF indicators, and we're talking about the economic sentiment and the current conditions. Both indicators are expected to improve. Should that be the case, that would imply practically that there's a greater degree of optimism about the next 6 months of the German economy. While should the current conditions improve, that would imply that the conditions on the ground right now are improving for the German economy. Both of the indicators are essential in more or less gauging the outlook for the largest economy in the Eurozone. Other than that, I would also be noting from the UK we get the CBI industrial trends. It's for orders, it's for February. And should that drop deeper into the negatives, that would be somewhat worrisome and could weaken the pound. And I would also be noting from New Zealand the dairy prices, it's a bi-weekly figure, and could more or less provide some support for the Kiwi, given that New Zealand is a major milk producer.
And how about the American session?
In the American session, I would be highlighting definitely Canada CPI rates. There for January. Now, we have to see the release of the Canadian CPI rates in a greater context. We had Bank of Canada, which tended to remain quite hawkish. We had good employment data from Canada. It could be better, but it was pretty good. Actually, it was very good. And hence, the next piece of the puzzle for BOC is going to be inflation. And today in the American session, we're going to be getting the actual rates and see whether inflationary pressures have accelerated. Should that be the case, we may see the bank's hawkish stance solidifying and leading to more rate hikes. On the flip side, should inflationary pressures ease, that may not automatically mean that the bank will pause hiking, but still could ease the hawkish stance of the bank. Other than that, I would also be noting Canada's retail sales, yet most probably December's retail sales are going to be overshadowed by the CPI rates. We have also the preliminary PMI figures, the S&P PMI figures of the US for February. We tend to focus more on the manufacturing sector, but also the service sector is not immaterial, it's quite substantial. A possible improvement of the indicators could provide some support for the US dollar, as that would imply improved economic activity throughout the economy. And later on, as the Asian session is about to start, we're getting from New Zealand the trade data, with the trade deficit being an issue. Should the trade deficit widen, we may see the Kiwi retreating, as that would imply practically that New Zealand's economy suffered more from its international trading activities.
And what is due out during tomorrow's Asian session?
During tomorrow's Asian session, there is a release which usually tends to pass under the radar. And that's Australia's wage price index for Q4. Now, the release as such usually tends to be characterized from medium to high impact, mostly medium. But in today's release of RBA's meeting minutes, the wage prices have been mentioned specifically as a factor feeding inflationary pressures in the Australian economy. So should we see an acceleration of the wage price index growth rate for Q4, that would mean that practically wages will continue to feed inflationary pressures in the Australian economy as well. And in turn, that would imply that inflation may not have peaked in Q4, may accelerate even further. That would add more pressure on RBA to tighten its monetary policy. Other than that, I would be noting definitely from New Zealand RBNZ's interest rate decision. The bank is expected to hike rates by 50 basis points and raise them from 4.25 to 4.75 in a one go. And it's characteristic that NZD/S imply probability of around 97% for such a scenario to materialize. That means that the market has almost fully priced in that it will happen. The next big question, should the bank actually proceed with a 50 basis points rate hike, would be the accompanying statement. Should the bank include in the accompanying statement a hawkish tone, a confident tone, foreshadowing more rate hikes to come, that could push the Kiwi even higher. On the flip side, should there be some hesitation or some innuendos that it may start reconsidering the monetary policy tightening, that could weaken the Kiwi. Other than that, I would be also noting a speech that would be BOJ board member Tamura. usually we do not tend to highlight BOJ board members, but Mr. Tamura was the one which noted the need for a review of the negative impact of BOJ's ultra-loose monetary policy on the Japanese economy, which more or less, I wouldn't say that he dissented, but he was the least dovish voice in the bank. So I wouldn't be surprised to see some slightly hawkish elements surfacing in his speech. And given that we have also a switch of BOJ governor in April, that could generate some interest for BOJ and move JPY.
Great. Thank you, Peter, for your time, and everyone for watching. Join us after a short break for technical analysis with Peter Yosif.
So welcome to the technical analysis part of the presentation for today. My name is Peter Yosif, Senior Market Analyst at IronFX. In front of your screens, you have the US dollar index. It's the 4-hour chart. All charts to be presented are to be of the same time frame unless otherwise stated. Now, what we notice after the breaking of the upward trend line, the US dollar index seems to be stabilizing just above the 103.75 support line. It was characteristic that we had some very slight bullish tendencies during today's early European session, but I would note the correction lower later on. So overall, we have nothing conclusive here. On the contrary, I would say that the correction lower underscores the outlook for the sideways motion to continue just above the 103.75. The RSI indicator jumped but corrects lower, once again nearing the reading of 50, implying a rather indecisive market. It's currently at 54.9.4, sorry. Should, though, the bulls take over and move the pair decisively, we may see it aiming, if not even breaching, the 105.40 level, which provided resistance practically around the 6th of January. On the flip side, should the bears take over, we may see the price action dropping, breaking the 103.75 support line, and start aiming for the 102.45, a level which provided support on the 14th of February, once again on the 9th of February, while it even provided resistance, and that was back on the 31st of January. Once again, overall our outlook remains sideways, also enhanced by the narrowing of the Bollinger Bands. Let's have a look at Euro USD. A sideways motion, maybe some slight bearish tendencies, which are being supported also by dropping moving averages. I would be changing the outlook somewhat. And let's have a second look at this. It resembles more like a channel. It's a downward channel, very low, like this. So it's going to be interesting to see whether that channel is going to be verified. Should that be the case, we may be talking about some bearish tendencies. Mind you that the RSI indicator has been dropping slightly below the reading of 50. It's currently at 42, which may also be implying that the bears are slowly but steadily taking over. Yet for a bearish outlook, I would require a clear breaking of the 1.0655 support line and the price action to start slowly but steadily marking lower truths, thus starting to aim for the 1.05. Should the S1 actually hold its ground and remain a support line, then we may be talking about some stabilization. Because in such a scenario would imply that practically the price action would be bouncing on the S1, rising slightly above it and remaining stable. In that case, we may see even the price action breaking the upper boundary of the downward channel. Note that the Bollinger Bands have narrowed, which may imply low volatility for the pair. The price action remains below the 100, 50, and 20 moving averages. And that, in my opinion, tends to remain also a slightly bearish indication, given that we had already the bearish cross and the downward slope of all three indicators is clear. Should the bulls take over, we have mentioned this, we would expect a breaking of the upper boundary, and the price action though would have to reach, if not even breach, the 1.0790 level, which provided resistance here, was tested here, and tested as a support level here. While on the flip side, the 1.05 support line, note how it's currently testing right now, the 1.0655. Anyways, the 1.05 provided support here. Let's have a look at cable, which jumped relatively high. I sense that the margins may be too wide here, and repositioning or recalibrating of the margins may be necessary. Especially the R1 with S1 has a very wide distance. On the other hand, we have to note that if we clear the trend lines, then we can see the price action remaining in a sideways motion between the 1.2215 and the 1.1970. Okay, for the time being, I'm keeping it. We note the jump of GBP USD, and I think it will become more clear to see if we drill into the 1 minute chart. Note the rise, the abrupt and substantial rise of cable, and that was practically at the release of 11:30. That was practically on the release of the preliminary PMI figures for February. We're talking about a jump within 5 minutes of 76 pips. So it's substantial. Practically what we are seeing here is the market reaction to the release of the preliminary PMI figures for February. We haven't mentioned this in the fundamentals before. What happened was that the services PMI indicator rose far more than expected, reaching 53.3, which more or less highlighted the growth of economic activity and the acceleration of the growth of economic activity in the services sector of the UK. Mind you that the services sector in the UK is the main sector to watch out for, and that's why, because practically the services sector comprises almost 65 to 70% of the country's GDP. So should one be watching out over the UK economy, he or she will have to primarily watch out for the service sector first. A very, very nice jump. And it's interesting that the pair rose and maintained the level over the past half hour. So it maintained the gains it made. Back to the forward chart. So for the time being, we tend to maintain the sideways motion bias. But I will be narrowing the support and resistance lines, especially the resistance lines. I would be setting this as a mid-level. Oh, sorry. And this could go a little bit higher. Note how this level was tested and tested again here. Something like this. Could go lower, as it was. At 1.2345. 24.35. Okay. Let's correct also the labels. Before we do that, let's have a look also at the S3. Okay, we could narrow it down here. A double touch, which is quite interesting. Let's lock everything in and correct the levels as well. Making a start with the S3, which is now being placed at 1.1710. The S2, which remains at 1.1840. The S1, which remains at 1.1970. The R1, which is now being placed at 1.2115. Mind you that the pound is also supported on a more fundamental level. Let me check that. And that's at 1.2265. And the peak, or the highest level in our chart to be exact, is the 1.2435. For the time being, we tend to maintain a bias for the sideways motion to continue, and that would be between the 1.2115 and the 1.1970, so it would be a movement like this. But we highlight the bullish tendencies of the pair. Let me also readjust the moving averages. The green one goes to become the 50 moving average, and the orange one to become the 100. Wow, very interesting. So we have some bullish tendencies. Why? Because we see that there are a number of two practically higher troughs and peaks. So there seems to be a bullish outlook slowly building up. That's supported also by the RSI indicator, which has risen to the reading of 58. Okay. It's a respectable difference from the reading of 50, which implies a rather indecisive market to the upside. Should the bulls take over, I wouldn't be surprised to see the price action breaking the 1.2115 and start aiming for the 1.2265, a level which provides resistance here and support here. On the flip side, should the bears take over, we may see the price action dropping, breaking the 1.1970 and start aiming for the 1.1840. Any movement which remains and respects the R1 and the S1 tends to be viewed more as a sideways motion. Okay, let's move now to USD and JPY. Readjusting the labels just slightly. Definitely on the one hand, we tend to highlight the sideways motion of the pair. It's a very narrow range-bound movement. But note how the pair is testing the 134.75 resistance line. It's as if the bulls want to break out. And in this case, I would be also noting the RSI indicator, which is at 62.5. More or less, that would imply that the bulls seem to be having an effect. So we have two conflicting signals here. On the one hand, the sideways motion of the past 48 hours and the narrowing of the Bollinger Bands tend to imply that we have the prospect for a sideways motion to continue just below the 134.75. On the other hand, the testing of the R1, the fact that the price action remains above the 20, 50, and 100 moving averages, and note also the upward slope of all three of them, tends to highlight the bullish prospect, as does also the RSI indicator, which is at 62. So should the bulls take over, I would expect the price action to break above the 134.75. We may see them hitting on the upper Bollinger Band, and that may slow them down somewhat, but the ultimate price here would be the 137.80. On the other hand, should the bears take over, we may see the price action dropping. I would require a lower movement below the 132.85 support line, breaking of the S1 for a bearish outlook, and the price action to start aiming, or at least pave the way, for the 130.40 support level. That would also allow us to draw a nice downward trend line. Okay, Let's have a look at USD CHF, the other safe haven currency pair. Sideways motion continues. Let's show the limitations here. So we maintain our bias for the sideways motion to continue. On the other hand, though, note how the price action practically in the early European session once again took a swing at the 0.9275 resistance line. The RSI indicator is at the reading of 50. Actually, it's at 51.5, also implying a rather indecisive market. The sideways motion seems to be valid still. For a bullish outlook, I would require clear breaking of the 0.9275 and the price action to start aiming for the 0.945. So practically, the upper boundary of its current sideways motion has to be broken in order for the bullish outlook to emerge. On the other hand, should the best take over, I wouldn't be surprised to see the price action dropping, breaking the 0.9145, a level which provided support here, here, and here, and start aiming for the 0.9025. For the time being, though, the first signal for a possible bearish outlook, because don't forget it has broken this level before, would be the breaking of the S1, which would allow us also to start drawing a downward trend line starting from here. Let's have a look at the Aussie. Okay, let's correct the labels, reposition them. It's interesting how the pair has tested, it's actually testing once again the 0.6880. There seem to be some bearish tendencies here. On the other hand, though, don't forget that the price action seems to be revolving around the S1, setting the limitations for a new sideways motion. The RSI indicator has dropped below the reading of 50, nothing conclusive yet, but still should be noted. Should the best take over, we may see the price action clearly breaking the 0.6880 support line and start aiming for 0.6740. Definitely for a bearish outlook, I would require a lower trough than this one. On the flip side, should the bulls take over, we may see the price action rising, aiming if not even testing the 0.7010 resistance line, a level which provided resistance here, support here, and here. So it's a pretty valid level as well. Let's have a look at USD CAD. Let's reposition the labels a little bit. What we are seeing here is practically that USD CAD maintains a sideways motion. It's a very tight range bound motion just below the R1 1.3470. The RSI indicator remains near the reading, just above, but near the reading of 50. Both of these elements, in conjunction with a slight narrowing of the Bollinger Bands, tend to imply a sideways motion. and we tend to maintain this view. Should the bulls take over, and I'm talking about a clear bullish outlook, that would mean practically that the price action of USD CAD has to break above the R1 1.3470 and start aiming for the 1.37. On the flip side, should the bears take over, we may see the price action dropping, and I would require the price action to aim, if not even breach, the S1 1.3285 support line. Let's have a look at WTI, given that we have discussed here the Canadian dollar, which is heavily influenced by oil's prices. Okay, there's lower volatility in WTI's price. There's a sideways motion. But in my opinion, I think we are going to have to readjust the resistance support lines. Given the low volatility, they seem to be too wide. I would be marking the S1 here, the R1 here, the R2 stays. Mark these shows here, could be a little bit lower. And let's readjust, allow for the price action to rise, correct the upper boundary. These touches here are very interesting. Verified again. Pretty nice. And let's also discuss support lines, the S3 specifically. I note this true, but in my opinion, it's way too near the S2. Let's move further back. Using this true here, which also had a peak to the upside. So it's a double affirmation. Okay, let's reposition them. Making a start with the R3, which is now being placed at 85.60, 70. The 82.65 remains. And in the R1 section, we're setting it at 79.50. So that would be the first resistance line, $79.5 per barrel. $75.35 is going to be the first support line. Note the touch here, here, and to the upside here. $72.55 being the second support line. and the final support line being placed at 69.15. Locking everything in. Given that the downward motion has been broken, we switched our bearish outlook in favor of a sideways movement, and we keep that. Despite a slight drop during today's Asian session, we can see that in the European session, WTI's price corrected higher. I would require consecutive higher peaks and higher truths and the price action to aim, if not even breach, the 79.50 before switching my sideways bias in favor of a bullish outlook. On the flip side, note how the Bollinger Bands are dropping, have a downward inclination, especially the 20 moving average. Note how it has crossed both the 50 and the 100 and seems to be pointing downwards, implying some bearish tendencies for the commodities price, in which case we may see the price action of WTI dropping, breaking the 75.35 support line, and start aiming for 72.55. Let's have a look at Nasdaq. Here you are. It's an interesting element in the sense that the price action is still in the sideways motion, but it's consistently testing the lower boundary, the 12,220. We had a beautiful test in today's European session, and that may imply some bearish tendencies. Also note how the 20 moving average, the median of the Bollinger Bands, and the upper and lower Bollinger Band have practically have a downward inclination. And in addition to that, we also note the RSI indicator, which is currently at 34.75, pretty low, which may imply that the bearish sentiment is slowly but steadily settling in. Yet, for a bearish outlook, I would require a clear breaking of the S1 12,220. Otherwise, if the S1 is not broken and the price action remains between S1 and the R1, actually even the 12,760 R2, we may be talking about a sideways motion. It's characteristic. If we drill out to the daily chart, it becomes far more clear how the upward movement was interrupted. And it was something like this one. That's gone. It stopped. So we're talking about a stabilization with some bearish tendencies. Back to the 4-hour chart. Yeah. Once again, for a bearish outlook, I would require a clear breaking of the S1. Let's have a look at at Dow Jones as well. A similar picture. Here we go. A sideways motion, a wide sideways motion this time between the 34,400 and the 33,460. A level which we can see how provides support here. It was broken, no, it was tested here once again and held its ground beautifully. The RSI indicator though and the dropping Bollinger Bands tend to imply that we may have some slight bearish tendencies. Currently, the RSI indicator is at 40.4. But once again, for a bearish outlook, I would require clear breaking of the S1 33,460. Anything else, and as long as the price action remains between the R1 and the S1, for us is a sideways motion. Should the bulls take over, we may see the price action rising. We would require breaking of the 34,400, and that would open the gates for the 35,500. So that should sum it up from all of us here at IronFX. Best wishes for solid trading.
Everyone, today we are going to talk about risk sentiment. Risk sentiment is a term used to describe how market participants such as traders and investors are behaving and feeling. Are they seeking risk when they feel positive about the economy, or are they seeking safety because they feel the economic outlook is gloomy? What traders buy or sell involves balancing how much they are willing to lose with how much they want to make. Risk sentiment can be viewed as an expression of traders' and investors' readiness to take on risk. This entails understanding risk and the market's risk attitude, as well as determining how much risk you are willing to take with your money and assets in a certain time frame. Risk sentiment is the general mood of the financial market. The exposure to the possibility of danger or loss is referred to as risk. When you start a position in the market, you are taking on a risk because there is a chance that your trade will result in a loss. Traders are sensitive to the two fundamental emotions that drive their decision making: fear and greed. The financial markets then play on this risk sentiment of traders. With traders speculating on the movement of currencies or other assets in the short term so they can enter and exit trades fast, risk sentiment is very important. Understanding how markets respond to risk or expecting how the markets will change will help you to determine your trades and trading strategy. Thank you so much for watching us today, guys. Bye-bye.
Okay, just a disclaimer. The information in this webinar should not be considered investment advice or an investment recommendation, but instead educational material only. Okay. So this material is just a personal opinion of the authors and the client's investments objectives, and risk tolerance have not been considered. Okay, IronFX is not responsible for any loss arising from any information contained. So redistribution of the material is strictly prohibited. Okay, I think I might have a setting that I need to change. Okay, wait. Okay, give me a moment. Setting up. Okay, let me continue. Kindly increase your volume. Yes, please increase the volume. I think I'm speaking at the max as loudest as I can already. So let us begin. So I'm actually from Everest Fortune Group, and my name is Chen Yongjing, and I'm the trade analyst for the company. We are the finalists for the best Forex research for 2019, 2020, and 2021. We are also the finalists for the best equity research for 2020 and 2021. So right now we actually have a special collaboration with IronFX, where we are bringing you guys the good stuff. So IronFX right now, you can actually go to ironfx.com. For those who do not know, you can go to the website. If I'm not wrong, IronFX School under webinars listed as popular. You can see the, let it load first. Okay, you can see the, okay, I'm not sure why my face is not up here yet. All right, it's okay. So you can actually see the upcoming webinars. Wait, let me find the, okay, over here. We have the timetable for the upcoming webinars that you guys can actually attend. So right now is this webinar. This webinar is live. So feel free to check this link out. So by the way, I know some of you guys want to contact me outside of this webinar. So feel free to check out my link tree. So this is actually a quick guide about myself. You can actually check out my Instagram, my YouTube, my LinkedIn profile. Feel free to follow me. All right, let us begin. So today will be a shared webinar. It will be with myself, Yongjing, and Sarah. So at the second half of this webinar, Sarah will be taking over. Okay, let us continue. So a few topics to cover today. So we'll be covering on, let me pull this chat around. We'll be covering on basics of news trading, key news events to watch out for, how each news event affects the markets, and 3 types of news trading strategy. So today will be a very, very dry lesson. So be prepared, get your coffee. I won't be showing much technicals. Today is all about the news, all about fundamentals. It might be boring, but it will help you a lot in a basic understanding of how news events actually affect the market, how you can bank on it to, scalp or either take a long position. So coming up first, 4 main factors to consider. Firstly, it's crucial. Okay, you can see a few points here. News events to pay attention to, what news events you want to pay attention to, and the expected data. So you want to also check the price reaction from previous news release. So firstly, it's very crucial to keep track of news events. I'm reading these points. And expected data releases. Economic indicators such as GDP, let me write this down, GDP, unemployment rates, inflation, can significantly impact currency values. Therefore, keeping an eye on the economic calendar and being aware of upcoming news releases can give traders like you guys an edge in predicting the market movements. So secondly, the price reaction from previous news releases is also an essential factor to consider. Traders can analyze how the market reacted to previous data releases and use this information to make educated guesses about how the markets will respond to future releases. So doing so, what you can do is you can go to Forex Factory. Let me show it to you. You can head on to Forex Factory. I'll send the link to the chat, so it's under calendar. Feel free to check out this link. Forex Factory, head on to Forex Factory. You start to look at all the news events. For example, tonight we have the United States dollar, core retail sales month-on-month, Empire State Manufacturing Index, retail sales month-on-month. So you do not know what does it do, how does it affect the markets. So what you can do, you can read a quick summary, click on it, read how it usually affects what you can have a summary change in total value of sales at the retail level, excluding automobiles. Can read more details about it. Go back to the forecast. So I think the more important one is core retail sales. So you can go back to the previous data release, which is on September 15, 2022. Go to your chart, click on it, start to go back and see how the news event actually impacted the United States dollar. So go head on to your DXY chart. Negative 0.3% versus previous 0%. So September 15, we can take a look at it. Let me load out my layout. Okay, so we'll be going through on core retail sales month-on-month on the DXY chart. Okay, DXY. So let's go back on the daily chart. September 15. September 15, right here. So notice upon the news release, price actually caused price to continue moving up in the long run. So you can actually start to look at maybe the 4 hours or 1 hour chart, want to see what happened on September 15. So September 15 around at night, price actually shot up before heading back down. You can start to check a reaction, what it does. Hits up first, clears the previous high. So every different news release is very, very different from each other. So find out the characteristics. First, it went up, cleared the previous high, went back down, tapped into some kind of support. So you back test it and back test this. I'm just giving you a very, very basic example. So you start to move on. I wouldn't be showing everything. So you'll be moving on to October 14, 16, December 15, January 18. Start to look at all this data, how it affected, how price moved. Get into accounts. Please do not just jump right in and try to trade the news event tonight just because you did some quick back tests on core retail sales and retail sales, Empire State Manufacturing Index. So moving on back to the charts. Okay, back to the PowerPoint. So current trend, why is it very important? Okay, current trends in the markets are another crucial aspect of Forex trading. Traders can use technical analysis tools to identify trends, such as moving averages or trend lines. It's essential to know whether the market is trending upwards, downwards, or sideways, as this will influence trading decisions and risk management strategies. So last but not least, support and resistance levels is still very, very important in Forex trading. Important to consider So these levels actually represent price points at which the market has historically shown supports or resistance. Traders can use this information to determine where to set stop loss. So you can use it as a gauge stop loss and where to put your take profit level. Okay, moving on next towards the news events and expected data. So we actually have a very nice clear screenshot of Forex Factory. So as Forex traders, it's very essential. Okay, before I continue, so we are actually focusing on the AUD. So right here, this specific news event is what we are focusing on. So as Forex traders, it's very essential to place close attention to the economic calendar and be aware of any upcoming news events and expected data releases. Firstly, these events can cause significant market volatility, which can lead to increased trading opportunities. For example, if a news event indicates that a country's economy is improving, traders might buy that country's currency, expecting it to strengthen. So as a result, the value of that currency might increase, creating a trading opportunity. Okay, secondly, moving on to the expected data part. News events and expected data releases can provide valuable insights into the health of an economy. So these indicators can help traders understand how a country's economy is performing and whether it is growing or contracting. Traders can use this information to make informed trading decisions, such as deciding whether to buy or sell a particular currency. So third points that we want to go through. News events and expected data release can influence central bank decisions on interest rates. So we have the Bank of England, the Reserve Bank of Australia, etc. So can influence central bank decisions on interest rates, which in turn can affect currency values. So central banks actually use interest rates to control inflation and stimulate or slow down economic growth. So if a central bank announces a change in interest rates, it can impact the currency value and create trading opportunities. So last but not least, news. So just to summarize overall what I've just talked about this entire slide. In summary, news events and expected data releases actually help traders to manage risk by providing insights into the potential impacts of specific events on currency values. So for example, if there is an expected data release that could significantly impact a currency, traders might choose to exit a trade before the release to avoid the potential volatility. So this is why I do not trade 1 hour, about 1 to 2 hours before the news release or 1 to 2 hours after the news release. So personally, I avoid that just to prevent any mishaps in my trading accounts. I do not want my trade to potentially cause slippage, potentially hit my stop loss, just because I wanted to be greedy and try to trade the news. So we are looking at the Aussie dollar, Australian dollar right here. So we had a cash rate. So they actually increased the interest rates. So previous was 1.35%, the forecast 1.85%, and the actual was also 1.85%. So what happened? Let's take a look how the news impacted the Australian dollar. So Australian dollar chart. So every time Australian dollar had a 50 BPS hike on the 7th June, price went down. 5th July, 50 BPS hike, price went down. 2nd August, BPS hike, price went down. 6th September, 50 BPS hike, price went down before going back up. and continued going down. So we already know we have a data set, we have proven data on the charts. Data do not lie. So every time we have a news release like this, we can expect to possibly sell Australian dollar, AUD, USD, every time we have a cash rate news event coming up. So please screenshot this down before I continue. So I've already helped you done most of your homework, maybe for this specific news event. Please screenshot this down before we continue. Okay, moving on next. So I'm just zooming in on the 5th July. I'm zooming in on this right now, on this specific day that actually happened. So I cannot remember specifically because I actually did quite a number of research. So zooming in on the 5th July, 50 BPS hike, price went up, cleared the previous high right there before it, moved down all the way down towards the previous swing low, and it actually formed a support right there. So you already know price goes up first before heading down. So please screenshot this down before we continue. This is still related to the previous slide that I just showed you guys. Okay, next. The 2nd August 50 BPS hike. You notice that price also went up first respectively right there. On a smaller time frame, it then, after the news release, immediately went down towards the previous support level. So every time we can expect price to likely head up first before the news release, before potentially just continue heading down towards the next key support level. Okay, moving on next to the key news events to watch out for. So we actually this is quite a long slide that I have to go through. So there's a theme of economic focus on what happened in the past, how it affected the markets, all the fundamental drivers that affected. First of all, going through the global financial crisis. It happened during the 2008 to 2009. Then the economic focus was a lot on employment data and wage growth. So for those who do not know, the global financial crisis is also known as the Great Recession. So it had far-reaching consequences for economies and individuals worldwide. It was triggered by a combination of factors, including subprime mortgage lending, a housing market bubble, and excessive risk-taking by financial institutions. So the crisis actually resulted in widespread job losses and had a severe impact on the employment market. So the unemployment rate in the United States, for example, it rose from 5% in 2007 to a peak of 10% in 2009. So many companies struggled to stay afloat, and as a result, many workers lost their jobs. Additionally, the crisis had a knock-on effect on other economies, leading to job losses worldwide. The crisis also had a significant impact on wage growth. As unemployment rates rose, employers had less incentive to offer pay rises or bonuses, and some even cut wages. So in the US, wage growth slowed from 4.4% in 2006 to 1.8% in 2009. So let me draw it. 4.4% in 2006 to 1.8% in 2009. So it made it difficult for many individuals and families to make ends meet. Okay, let me write this down. Unemployment data, 5%. 2007, it moved to a peak of 10% in 2009. So the global financial crisis had a domino effect on the world's financial markets as the interconnectedness of the global financial system became evident. Financial institutions that had invested heavily in mortgage-backed securities and other high-risk assets faced significant losses. And many banks and other financial institutions went bankrupt or required government bailouts. The crisis also prompted significant government intervention. Central banks around the world cut interest rates, and governments introduced stimulus packages to try to prop up their economies. However, it actually took several years for the global economy to recover fully from the crisis, and many countries are still feeling its effects. So overall, the global financial crisis was a watershed moment in the world economy, with far-reaching consequences for individuals and economies worldwide. The crisis had a very severe impact on employment and wage growth, leading to a significant job losses and slower wage growth. So the financial markets and central banks all had to take unprecedented measures to address the crisis, and its effects are still being felt today. Next, we have the COVID pandemic. I guess we just got out of it. So now it's the post-COVID. So COVID happened 2020 to 2021. All of us went through it. The pandemic had far-reaching consequences for individuals, economies, and societies worldwide, and its effects will be felt for years to come. So one of the most significant impacts of the COVID-19 pandemic was on the gross domestic product, the GDP. So which is actually a measure of a country's economic activity. The pandemic led to a massive decline in economic activity as many businesses were forced to close or operate at reduced capacity due to lockdowns and restrictions. So the International Monetary Fund, the IMF, estimated that the global economy contracted by 3.3% in 2020, the most significant downturn since the Great Depression. So the pandemic also had a significant impact on employment. Many people actually lost their jobs due to business closures or reduced hours. The unemployment rates increased in many countries, and the number of people working part-time or on a reduced pay also rose. So as a result, many individuals and families experienced financial hardship, making it difficult for them to meet ends meet. The pandemic had very, very significant consequences for healthcare systems, with hospitals, healthcare workers overwhelmed by the sheer number of COVID-19 cases. Governments around the world had to invest heavily in healthcare infrastructure, including building new hospitals and acquiring medical equipment, such as ventilators and personal protective equipment, PPE. So moreover, the pandemic had a profound impact on global supply chains, with disruptions affecting industries such as manufacturing, agriculture, and logistics. Travel restrictions and border closures also led to a decline in global trade, affecting economies worldwide. So overall, governments and central banks around the world responded to the pandemic by implementing fiscal and monetary policies to support their economies. Many countries introduced economic stimulus packages, and central banks lowered interest rates to encourage borrowing and spending. So right now we have the 2023 recession that is coming up. So we'll be focusing on inflation data and interest rates. So this recession was triggered by several factors, including inflation, rising interest rates, and the COVID-19 pandemic. So inflation was one of the most significant factors contributing to the recession. So in many countries, inflation rates reach historic highs due to supply chain disruptions, labor shortages, and rising commodity prices. Commodity is wheat, corn, rice. So high inflation led to increased costs for businesses and consumers, causing a decline in purchasing power and economic activity. Interest rates were also a contributing factor to the recession. Central banks have raised interest rates in response to the rising inflation, which made borrowing more expensive for businesses and individuals. So higher interest rates also led to a decline in consumer and business spending, reducing economic activity. Okay. Give me a moment, let me get a cup of water. The COVID-19 pandemic also had an impact on the recession. The emergence of new COVID-19 variants and the resulting restrictions led to reduced economic activity and job losses. Many businesses, particularly in the hospitality and tourism industries, were forced to close or operate at reduced capacity, resulting in a decline in economic output. So the recession is leading to a significant increase in unemployment rates in many countries, and many individuals and families experience financial hardship. So governments are responding to the recession by introducing stimulus packages and implementing monetary policies to support their economies. Central banks around the world lowered interest rates and introduced quantitative easing measures to support the economy. Governments also introduced fiscal stimulus packages to support businesses and individuals. So these policies actually help to stimulate economic activity and support job growth. So this is just for general information about what has happened in the past 15 years or so. Okay, let me see what's next. Okay, non-farm and employment change. So this is a very, very important thing. It actually occurs on the first Friday of the month. Okay, one of the most closely watched, okay, just these 3 points, screenshot it down. It's related to the change in number of employed people during the previous month, job excluding the farming industry. So this is only for the United States only. Only US, it's not anywhere else in the world. So job creation is an important leading indicator of consumer spending, which accounts for a majority of overall economic activity. So it's also a high price volatility event. So NFP, also known as non-farm payroll, is a key indicator of the health of the US economy and is closely monitored by traders, investors, and policy makers. So NFP measures the number of new jobs created in the United States, excluding the agricultural sector. The report is released by the US Bureau of Labor Statistics on the first Friday of every month and provides insights into the strength of the US labor market. So the NFP report provides two pieces of information: the number of new jobs created in the previous month and the unemployment rate. The number of new jobs created is a crucial indicator of economic activity, as job growth typically leads to increased consumer spending and overall economic growth. The unemployment rate, on the other hand, provides a measure of the health of the labor market and can influence central bank policy on interest rates. So the NFP report is considered a leading indicator of economic growth and is closely monitored by traders and investors. A better than expected NFP report typically leads to a rise in the US dollar's value, as investors anticipate increased economic growth, and the possibility of higher interest rates. So a worse than expected NFP report, on the other hand, can lead to a decline in the US dollar's value. So as investors become less optimistic about economic growth and the possibility of interest rate increases. The NFP is also closely monitored by policymakers, including the Federal Reserve. The Fed uses the NFP report to determine whether to raise or lower interest rates. So with higher employment rates, it actually leads to higher interest rates. Okay, please screenshot this down before we continue. Okay, next. Moving on towards interest rate decisions. So central banks hike interest rates to increase the cost of borrowing. It slows down economic activity. These are the main important points only. Please screenshot it down. It reduces or slows down the speed of inflation, and is also a high price volatility event. So, interest rates are a crucial tool that central banks use to manage inflation, economic growth, and financial stability. Interest rate decisions can have a significant impact on currency exchange rates, stock and bond markets, and individual financial planning. So interest rate decisions are made by central banks, which are tasked with maintaining price stability and supporting economic growth. Central banks can adjust interest rates up or down depending on economic conditions and their policy objectives. A rise in interest rates can reduce consumer spending, lower inflation, and support a currency's value. A cut in interest rates can stimulate borrowing and spending, support economic growth, and weaken a currency's value. So interest rates are typically announced after a meeting of the central bank's monetary policy committee. The announcement includes a statement that outlines the central bank's reasoning behind the decision and any future policy changes. The statement can provide insights into the central bank's outlook on the economy, which can influence financial market expectations and individual investment decisions. So it can have a significant impact on financial markets. A rise in interest rates can lead to a decline in the stock markets as companies' borrowing costs increase and consumers may reduce their spending. So higher interest rates can also lead to a strengthening of the domestic currency, making exports less competitive. A cut in interest rates, on the other hand, can lead to a rise in the stock markets as companies' borrowing costs decrease and consumers may increase their spending. Lower interest rates can also lead to a weakening of the domestic currency, making exports more competitive. Okay, let's move on. So the inflation data, the CPI. So the consumer price index, so it actually measures the change in price level, indicates the change in the cost of living, and the target CPI for the economy is 2 to 3%. So please note this down. This is very, very important. Please screenshot this down. So the CPI measures the average change in prices paid by consumers for a basket of goods and services over time. So it's a crucial indicator of the health of an economy and is closely monitored by policymakers, investors, and consumers. So inflation is the rate at which the prices of goods and services increase over time. High rates of inflation can lead to a reduction in the purchasing power of money, making it more expensive to buy goods and services. On the other hand, low inflation can lead to deflation, which can harm economic growth and create disincentives for businesses to invest. So the CPI is used to measure inflation and is one of the most commonly used indices. The CPI calculates the average price of goods and services, including food, housing, food, housing, energy, healthcare, and transportation. Mind my writing. It's a bit hard to write using the pen. So changes in the CPI can over time provide insight into the rate of inflation. So the CPI is released on a monthly basis, closely monitored by policymakers and investors, provides insights in the state of the economy, and can influence monetary policy decisions. Okay, so high inflation leads to a rise in interest rates, which can increase the cost of borrowing and slow down economic growth. Low inflation can lead to a lower interest rate, which can make borrowing more affordable and stimulate economic growth. So inflation data also has an impact on individual consumers. A high rates of inflation can lead to increased costs for everyday goods and services, which can reduce consumers' purchasing power. Low inflation can lead to lower costs for consumers, making it more affordable to buy goods and services. Okay, let's move on. Right now, Sarah will be taking over. So yeah, let's welcome Sarah. I'll be taking my leave.
Hi everyone, my name is Sarah. Okay, so today I'm going to take at the second section of this webinar. So just now Eugene has mentioned it. Okay, so for the Kiwi dollar, the CPI news is really important. So now let's take a look at the next slide. It's about how the give me a moment. Let's take a look at this slide is how the news is affecting our price and how the price is reacting towards the news. Okay, you can see before the news come. Sorry, where is my mouse? Okay, here. Can you see my mouse? Okay, so you can see before the news come, there is a very nice steadily ascending trend line. So the price is going to react it according to the trend line. Okay, and you can see before the news come, the price is more in a consolidation, means the price isn't moving very much. Okay, so it's more like up and down, but in a more horizontal way. But you see at the 6 p.m., the news have come out. Okay, so the news will affect the price of the market. That's why the price has shooted up. Okay, shoot it until where? Shoot it until the period swing high. So always take note when we are reacting towards the news, always looking for a reference point. Don't always say that, oh, the price may go up to here or the price may go up to here. Okay, you need to find a reference point, which is very important. Most likely the reference point is the period swing high or the period swing low. Depends on how you judge the news going to affect the market. Okay, next one. Okay, so you can see here are all the news. Here are all the news of the. Here are all the news of it's very important news on the 13th October. So always. Okay, so always remember the news event. You need to pay attention and the expected data. Always pay attention on the current trend, okay? And always pay attention on support and resistance lines. So their price is going to reaction after from the previous news release, okay? So you need to take it as a reference. Okay, so here you can see there is a news coming up. I think it's at before the price is consolidation. So you can see the price didn't move a lot. After the news release, the price has shooted up and now retreats back. So how each news event affects the market? So for short-term effect, okay, so there are some news will affect it in a more shorter term. So for example, employment change, retail sales, and purchasing manager index. So later at 9:30 p.m., there are retail sales for USD. So maybe later we can pay attention to it and we see how the news is going to affect the market price. So employee change is a very key indicator of economy health and have short-term effect on our trading. A strong employment change report can indicate a growing economy and increase customer confidence, leading to a stronger currency. In another scenario, okay, a weaker employee change report can indicate a weaker economy, leading to a weaker currency. So most likely the employment change is correlated to the currency. So if employment change is good, okay, so the currency is going up. If otherwise, it will go down. So how about for retail sales? Retail sales are another economy indicator, indicate that short-term impact on the trading. So retail sales measure the total amount of goods and services sold by retailer. And a strong retail sales report can indicate increased customer confidence and spending. This can lead a stronger currency as the investor become more optimistic about the economy. A weaker retail sales report, on the other hand, can lead to a weaker currency as the investor become less optimistic about the currency. So this one same as employment change, okay? Retail sales good, currency go up. Retail sales bad, currency go down. So lastly, the PMI. Okay, so PMI is a survey of purchasing manager in manufacturing sector that measure the level of business activity. The PMI can have a short-term effect on forex trading. It provide the insight into the strength of the manufacturing sector and the overall economy. A high PMI indicated increased manufacturer activity and growing economy, leading to a stronger currency. So in alternate scenario, a low PMI will indicate a weaker economy, leading to a weaker currency. So all three of these are very correlated to the whether the strong or weak is the currency. So the better the number is, the better the currency. The weaker the bad the number is, the weaker the currency is. So bear in mind, so this three factor is only going to affect the currency in a short term, which means after the most likely after the news has been released, within like a few hours, or like within a short term, the price will be changed according to the news, but it's unlikely to going to affect the currency in long term. So now let's take a look at what will affect the currency in a medium to long term. What are the factors? So first one, very straightforward, is GDP. And another one, secondly, is the CIP. And lastly, the interest rate decision. So let's take a look at GDP, okay? GDP is a measure of country economic output and is considered one of the most important economic factor. GDP measures the total value of goods and services provided within a country border and provided insight into overall health of the economy. A high GDP can indicate a growing economy, which means a stronger currency. A low GDP indicates a weaker GDP and lead to a weaker currency. So imagine the news has released like United States, the GDP has went up, which means the price of the currency will go up. So secondly, let's talking about inflation data. Inflation data is measured by Customer Price Index, CPI. So it's another key economic indicator that can impact forex trading over medium to long term. A high rate of inflation can reduce the purchasing power of the currency, leading to a weaker currency. In other hand, low inflation can lead to stronger currency, which indicates a stable and growing economy. So lastly, our interest rate decision. Interest rate decision are also important indicator for our trading. So central bank use interest rate to manage inflation and support economic growth. A rise in interest rate can lead to a stronger currency, as the investor may be attracted to a high interest rate. Most they want to deposit in that interest rate, or because it's high interest rate, I can deposit over and to gain more interest. So in alternate scenario, in alternate scenario, a low interest rate means less demand of the money, which means the currency may be dropped. So this three factor or this three related news about this three factor is going to affect our currency in a more medium to long term effect. So imagine that this kind of news has been released, okay? Maybe the price may not move like a lot, but in the future or in a more mid to long term, the price is going to react to these factors. Now let's take a look at news trading strategy. Means how are we going to enter in a trade by the news or like according to the news. So there are three different kind of trading strategy. Firstly, entering before the trade release. So most likely we are looking at 1 hour or 15-minute chart. So what meaning by entering before before the release means we are predict on the numbers. Imagine like later the retail or the US retail news going to release. Okay, so let's just make a prediction whether the news is good or not than compared to the previous one. Okay, so if you are considering, okay, I have confidence in this, okay, the news is going to be good, means better than before. So this you may enter in the trade in a long position, which means I think, okay, USD will go up. So the goal is to catch the maximum move following the news release, because you are entering the trade. Most likely you are putting a buy or sell limit before the news release. So the strategy can be very dangerous, as the trader can take advantage of significant price movement. However, there is a risk of being backed off, as the market can react unpredictable to the news release, which means maybe the news may be good, okay, but the market did not respond in after the news come. So maybe the news good, but the price still dropping down. So maybe it will hit your stop loss. Then finally, the market has reacted to the news. There may be a chance in this kind of scenario. So how about our second strategy? Our second strategy is using pending order. This involves placing an order ahead of news release. Okay, so it's more likely using a 1 hour chart. The strategy has less emotional involvement. Okay, so as the traders set their orders and wait to the market to fill them. However, there is a risk of price spillage, as the market can move significantly after the news release, causing the order to be filled at a different price than expected. So our third strategy is to reacting to the news release. So means after the news release, we are reacting, we entering the trade according to the news. Most likely, we are using 15-minute or 1-minute chart. So this involves the trading you used it on 15-minute and 1-minute chart. Trader wait for the news to release or to come out, then they react based on the price movement. This strategy can be beneficial as the trader can react to what they are seeing in the market. However, there is a risk of being influenced by price movement and making irrational trading decisions. So each strategy has its own set of good advantage and disadvantage. So when we are entering the trade, think carefully to see which one is best fit your trading strategy. And also always remember, manage your risk. Trader must be prepared to accept the loss and have a solid risk management strategy in place before you enter in any trade. Okay, so that's all of today's webinar. Is there any more questions? So by the way, later at 9:30 p.m., there is a very important news on USD. So maybe you guys can pay attention on it. How would you feel the USD going to react? Okay, so if no more questions, I may just end today's webinar. Thank you, Adrika Das. Thank you, Iram Atadi. Thank you, Mogizi Likope. And thank you, Steve Code. Okay, forgive me if I pronounce your name wrongly, but really thank you for you guys attending this webinar. Okay, that's all of today's webinar. Thank you. Bye.